So everyone has heard of the age-old strategy of the 60-40 portfolio and that every retiree needs a 60-40 portfolio. But today we're going to talk about why most people with pensions may not need a 60-40 portfolio. We're going to talk about why and also talk about how it could lead to success in not having a 60-40 portfolio. And something we often talk about on this channel is that if you have a pension, and especially if you have $1 million or more saved, you're in a very unique situation. Less than 20% of people have a pension. Less than 10% of people have over $1 million. Combine those two percentages and you're only 2% of the population that is going to be in that situation of having that high income and high net worth. And so your planning is going to be more unique. For example, some people have probably told you you'll be in a lower tax bracket in retirement, but typically is the case with the people we work with is they're in the same or higher in the future. And very much so comes with their investments. You know, a lot of people say you've got to protect your investments when you get to retirement. But we're going to talk about what that looks like when you have a pension and more than $1 million saved.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So let's break this 60-40 idea down as we start here. So 60% equities, 40% fixed income is what they refer to there. So equities, that's going to be your stock market. That's going to be your small cap, large cap, technology type stocks. That's going to be dividend paying stocks. That's going to be all of those U.S. companies that is what most people think about. For the fixed income, people think of bonds, they think of CDs, they think of annuities, they think of money markets, anything more protected or anything that's less risky than stocks. So we do know with bonds, they could still lose money. We've seen that in past markets. Or you could look at more principal protection, such as those other vehicles that aren't going to lose any money. You know, think CDs as an example. And so a lot of people think, well, if I'm going to need income from my retirement, from my investments, then I need to make sure that money is protected. And that's a real thing. And it's something called sequence of returns risk. And sequence of returns risk happens when you take out money from a down market, especially early in retirement, which is a big concern for most people in America who has saved money. And the reason why is because, you know, if you take out from your investments, you know, that's one loss, but also if the market's down, that's two losses, and then you have to let it come back up over time. So you have one loss, two losses, and then you're in retirement, so you have to ask yourself, do you have enough time to make it back up? And that's why you'll see majority of Americans out there want to be more conservative and protected at this point in their retirement. When they were 20 years old or 30 years old, they were taking all the risk in the world because they knew they didn't need that money. But now they have to have that money. If the market's down, they'd either have to take out from a loss, as we just talked about, or they'd have to go without. And a lot of people don't want to miss opportunities in their retirement to enjoy it and be able to live out what they've planned over all these years. So that's why you'll see people go to that 60-40 model. And a lot of people like the 60-40 model is because, you know, you're still getting some upside with growth, but you're making sure it's protected. And a lot of it's going to depend on your situation if that 60-40 model is right. We never would tell anyone to follow any cookie cutter advice for retirement, especially our clients who have that more unique situation. So when we break this down, if you have a pension, well, your pension is considered fixed income. And so if you wanted to do an 80-20 portfolio, then you absolutely could, because maybe your pension would be what would be needed to fill in that extra 20% if you wanted to follow that age-old strategy, or if you wanted to be just like your peers, right? And so we always tell people with pensions that you can take on as much risk as you want, or you could take on as little risk as you want. And the reason why is because, you know, you can take on more risk because you have that guaranteed income, that fixed income component to the 60-40 portfolio that's coming to you for the rest of your life. And so if you want to take on more risk with your investments, knowing you may not need as much, then you absolutely could. But you may be in the boat where, hey, I don't like to see my money go down. I want to be conservative. Well, you may have bought yourself the opportunity to take on less risk because of all the saving you've done, but also because of that pension. And so you don't need double-digit returns anymore. You may not want to hit home runs anymore. Maybe you just want to hit singles and doubles, play it safe, make sure that's there if you ever do need it down the road. And so both of those options are valid options depending on if they meet the goals. And so we always run numbers for our clients to show them that, hey, if we're going to take potentially less return over time by ensuring it's protected, then we need to make sure we're not going to run out of money, or making sure we're not going to make any bad decision as time goes. So it could be a difference of two. It could be anywhere in the middle. And so that's what it depends on. So that's what we look at. But something else we also look at is how much income is needed. I mean, if you need $120,000 of income and $80,000 is covered by your Social Security and your pension, and you've had $2 million, well, then that's only a 2% withdrawal rate from your investments to get $40,000 out if you have $2 million. And so in that boat, do you really need 40% protected or even 20%? You could probably get by with a lot less, knowing you don't need as much income. And so what I want to talk about next on the video is, how do we plan for this? How do we plan to know what is that perfect number to have in protection? What should we be looking for as we put together our retirement plan on how much we should have protected? Now, first and foremost, as I mentioned, if you don't have an income need, you technically don't need anything in protection. If you don't plan to touch your investments in retirement, you can be as aggressive as you want, because you're not going to be worried about taking out money from a down market. Now, if you are assuming that you're going to need to have income in retirement, that's when we start to look more at the protection bucket. And so that's one reason. Then the second reason is your risk tolerance, as we talked about earlier. How much risk do you want to take? Are you okay seeing your investments potentially down 50% like 2008 when that happened? If that's the case, and you know that over time it's going to come back, hey, that may be something that makes sense. So let me share some statistics here that we look at with the clients that we serve to help get a better picture of what this right amount is to have in the protection bucket. Because if we overweight to the protection bucket, we certainly are missing opportunities over time. And so that's something we definitely want to weigh the pros and cons of. So if you look at the chart I have here, you're going to see, this is from the IFA 100, which is a diversified portfolio, and it's showing 100% equities. And what we're going to show here is over a time period, what does this look like? Is the market up or down over a certain period of time? And so we're going to start with the first one here, which is just a daily look at the market. And so if you look at the market, it's up 51% of the time, and it's down 48.55% of the time. So basically flip a coin. When you check S&P 500 to see where it's at, or if you check the Dow or whatever you check from a stock market perspective, it's going to be a 50% chance it's going to be up or down. And so you may think, well, is that a good investment if it's only a 50% chance to be up over time? And that's where we look at the next one, which is the monthly average. And so over the last 50 years is what this is showing, is what's the idea of ever a month period that the market will be down. So if I start with $100, am I going to make more than am I going to have more than $100, or am I going to have less than $100? And the stats show it's a 65% chance that you're going to have over $100 versus under $100, which is only about 34% there. And so you can see that, hey, if we just wait a little bit, more likely that we're not going to see as much of a loss in our investments. And so whenever we talk to our clients about this concept, we always say, when in doubt, zoom out, right? If you're going to invest in equities, if you're going to be more aggressive in your investments, if you're going to be more growth oriented, we can't look at this stuff every day, or we're going to drive ourselves crazy. Let's build out a plan so we can look at this over time, right? And making sure that we're not going to need this money from the equities in a short period of time. And what we're going to talk about as I show this, the rest of this example, is what is the right amount of time to make sure that we can have our money protected to buy us out of a down market. So, if the market's down for 5 years, well, we need to have protected for 5 years to make sure we're not pulling from that down market. So let's explore this further. So if we go out from a quarterly standpoint, you'll see there it's about 71% versus 29% up and down. So you can see we're continuing to see more ups and downs as the time goes further. And then if we go to 1 year, you're going to see closer to an 80% if the market goes up, and a 20% of it going down. And so a lot of people think, well, as long as I just have cash set aside for 1 year, then I should be fine. And that could be an applicable strategy. We typically would advise maybe it makes sense to look more at 3, 5, or even 10 years to really make sure you're not taking overly too much risk. But again, if you have a pension, you could probably do it. You could probably even sacrifice not taking out from your investments for 1 year if you really wanted to. So I would challenge you there to see if that's really what you want to do in retirement in a perfect world. Because at the end of the day, you should be looking to live out your perfect world in retirement, not basing it on what the market does to make your decision. So that's something to think about. You've worked 30, 40 years. Hey, let's not have the market control us in retirement. Let's make sure we have a plan. So everything we wanted to do, we're doing. We're not regretting it. We're not looking back and saying, man, I wish I would have done that. And so the next one that a lot of people go off of is a 5-year there. So over a 5-year period, it's almost a 97% chance that you will make money or be even on your investment. And this is in the 100% equities. Now, you have less than a 3% chance that it's going to be negative. And now, when we talk about negative, we're not talking about a 50% negative. Typically, this is a smaller amount that you've lost over a 5-year period. So no one would like to lose the money over a 5-year period, but worst case, historically, we've seen that has not been an issue. And then the majority of time, people are good to go. And so that's why if you're building an income plan, people suggest 3 to 5 years, always have that protected. I think that's a very applicable thing to do just to make sure that you're good to go. And just, maybe you do want to do a large expense that just comes randomly and maybe the market's down. Well, you don't want to be prevented from doing that. So that's what that looks like. And then if you go 10 years out, as you can see there in the chart, then it's 100% chance the market's been up over the last 50 years. So, that's where if our clients are overly conservative and hate the market, then we'll tell them like, hey, you could at least just put 10 years in protection and try to seek some growth. And if you see the market's down, just know you've got 10 years for it to come back up. So hopefully this is an educational and open, your eyes to know what this conversation looks like. But those are some of the key things to consider. So I want to talk about why it could be important to take on more risk. Because in a perfect world, if you had your idea of investing in something that had risk and something that had no risk, all day, every day, you're going to take the no risk option. That's just who we are. It's human nature. But what if there's more reward with more risk? As we know, that's the case. So the more risk you take, the more return opportunity you can get. And that's why it can make sense to not go the 60-40 route, to maybe go more of an 80-20 or a 90-10 or a 70-30 or something that allows you to have more growth potential if you're okay with the risk as we've talked about. But this can lead to a lot of extra cash, a lot of extra money over your retirement. And so I want to just use an example here. So if we have a growth rate of 7% as an example, your money will double in about 10 years. So if you have $100,000, that $100,000 is going to turn into $200,000. Well, if you have a 4% return, it's going to take you about 18 years to double. So for example's sakes, we're just going to use 20 to make it really easy to understand. And so if you have 100,000 and you only get a 4% rate of return, it's not going to go up like that. It's going to go up more gradually over time. And then you're going to have 200,000 in 20 years. And so I want to play this out for you to understand what this looks like. So let's say that you have a 60-40 portfolio. You've got $2 million. And you're thinking about, hey, do I really need $800,000 protected? What if you maybe looked at only protecting $400,000? What does it look like for that $400,000 that you can now move over to equities? What could that look like for your plan? So let's go through the numbers here. So if we are now able to shift it over to equities where maybe we're able to see a 7% rate of return on that, then we know that $400,000 in 10 years will grow to $800,000. And then we know if we go another 10 years, right, during our life expectancy, it's not outside the realm of possibility to see two doubles if we're not going to be taking out any withdrawals. If we do that over a 20-year period, this 400 will turn into 800,000 at 10 years, and then 800,000 will turn into $1.6 million in 20 years. Now, let's go and compare this to the other side of it. So if we decide to go the fixed income side and maybe we only get a 4% return, which has been historically, what you could expect in that side of the game, especially where interest rates are right now. And so if we go that route, well, then we have to wait almost 20 years for that $400,000 to double. So we're going to end up with about $800,000 at that 20-year mark. And so if that's the case, we look at this, You could either have 1.6 million or you could have 800,000 if you go more the conservative route. Now, you have to weigh that you are getting more peace of mind, comfort, security, stability with this 800,000, but the question I ask, is it worth $800,000 of lost potential gain over time? And obviously, that's no guarantee the market's going to do 7% over the next 20 years, but historically, that's what we could expect pretty simply there from an equity standpoint. And so you can understand the idea that you could be leaving a lot of growth on the table by being too conservative in retirement. Now, to defend those who want to be more protected, you may not need that extra $800,000 of growth. What are you going to do with it, right? But this is where you could think bigger. Maybe you have legacy goals. Maybe you want to leave more to charities. Maybe you just want to make sure you can build, the bigger barns there. And so if that's the case, there could be more use for this money over time. But if you're going to be counting on needing every dollar of it, then we may need to make sure that's protected for those income purposes that we talked about there. And so also to use this $2 million example, if we only need, in this example we talked about earlier, we needed $40,000 of income, right? They had $80,000 from Social Security and pension. They needed $120,000 to live on. So we need $40,000 to cover this gap. And so if that's the case, if we have a $2 million portfolio, something we may consider for them from a protection standpoint is covering maybe 5 to 10 years of income for that. And then we also want to factor in any large expenses that may come up in addition to that $40,000 of income. So maybe they want to go on a huge trip that is going to be outside of that budget, or they're going to do some home improvements. So that would just be added on top. But if all we need is $40,000 a year, well, $40,000 over 5 years is only $200,000. And so if we just want to protect 5 years of income for them, then we only need to do a 90-10 portfolio. If we did the 60-40, we would be protecting way more money than what we'd even need over the next 5 years. And if you really wanted to be conservative, which I don't think the market will ever be down over a 10-year period, is what my expectation would be. And so if that was the case, well, then, you're going to only need to put 400,000 there, which is still only 20%. So the 80-20 portfolio for someone in this case we're talking about could consider overly conservative, and that's, a lot of people think that's kind of strange knowing they've been told that 60-40 all their life. So hopefully this can open your eyes to just know what this looks like for your retirement, and then you can understand how much risk you want to take and how much you want to have protected. And if anything, I hope this video helps you understand that you're going to be in a great position in retirement. And so it's start to think about that purpose of money conversation that we talk about often on this channel. Is what are we going to do with it? Are we going to spend it? Are we going to gift it to our loved ones? Or are we going to give it to charities? But at the end of the day, we can't take this money with you. You've heard me say that 100 times on this channel. And so we need to make sure we have a plan in place to do what we want to do now that we have that financial freedom. Remember the how rare it is to have a pension, to have $1 million or more saved. And so if you're in this particular situation we're talking about in the video with a pension and 2 million, you're in a great position to start having these types of conversations to make sure that you are not running out of life with your wealth over these next retirement years, knowing you've worked so hard for it. So hopefully this can be encouraging for you. I hope this helps preface it better. And if you are looking for more content on this type of topic, go ahead and we'll have the team go ahead and upload a video here that you can click on and continue to watch and continue to get educated on all things retirement for those with pensions. So have a great rest of your day.